Well, the calendar clock spun around quickly. This is the time of year again when top down stock strategists look into their crystal ball and make projections on the year ahead. Our chief equity strategist and economist, John Blank, is no different, and he's here with us now. John, what do you see as the top risks or challenges for the markets in 2022?
Well, Terry, the most important risk for the markets, and this needs to be understood, so I'm going to make this very, very concise and clear, is not a set of very modest rate hikes, which the Fed announced they're likely to do, which is 3 rate hikes next year, one 25 basis point one, followed 3 months later by another one, followed by another one. So think about, June, Sep, Dece in terms of 75 basis points. The market can, let me repeat that, can historically continue to rise if that is the result of the Fed's decision making. That is just what they say they're going to do at this point in time. Now, what the market cannot overcome in historic terms, if you look at it, is a very rapid rising rate cycle, meaning 5, 6, 7, 8 rate hikes next year. That will kill the stock market. So, as stock investors, we're looking at a pullback here to 4,600 on the S&P 500. I want to remind everybody out there that I've had for the entire year nothing more than a 43.50 fair value. So all you're seeing here is some modest reduction of the excess liquidity that should be expected in this market as the Fed withdraws its liquidity. But it has more than likely a pretty good base at 43.50. And you still got to add back whatever liquidity is still out there, which is in the trillions. So it's very unlikely that we're going to get below 4,500, as a final year-end S&P 500 carry. And then next year, really, it's about these rate hikes and the speed of them.
Well, despite the risks, you seem to be bullish on the market still. You've written that your call is for the S&P 500 index to end 2022 at 4,900. Bottoms-up strategists think it reaches 5,190, a little over that mark, in 12 months' time. What's the key to the bullishness?
It's what we're talking about, single-digit fundamental revenue and earnings growth next year from, leaving this year around 4,600, getting to 5,000. That's basically 8 or 10% rise in the stock market. So it will be a muted expectation for a softer performance, but yet still a positive one.
What about the Fed taper in relation to the markets?
Well, the point of the Fed taper is to get it out of the way in March so that you can do your 3 rate hikes over 9 months as opposed to doing over 6 months, because they were never going to do rate hiking and tapering at the same time. They don't want to do that. They want to take these in steps. So there's actually 3 steps. They want to finish the taper. Then they want to leave the market alone for 2 to 3 months. And then after they acknowledge that the markets can digest it without becoming too volatile, then they can start a very measured pace of rate hikes. That is it is communicated to us. It will continue to be communicated to us very well. And these 3 stages, tapering to March, pausing all action to June-ish, and then beginning a very modest set of rate hikes is what to expect from next year.
What about for the global markets?
Well, the global markets are in a really interesting place valuation-wise. My CIO survey pointed out the real opportunities in Europe for those who would like to look for one. And I think, looking for strong, positive, growing, double-digit growing tech stocks or other stocks in those markets at this point in time makes a lot of sense. Some other people also like China because it's been so blown up by all the regulatory constraints and some of the issues that have gone on from their government perspective on the real estate side. But if they do flush the liquidity out of China and they get interested in raising their stock market, that's certainly going to be true for China too.
Having said all of that, do you have a game plan for investing to open up the new year?
I think the game plan is to stay away from non-profitable tech stocks. And I think the rest of it is to not overdo the pessimism, because your regular allocations to your 401k are going to get in at better prices now. And in general, when I look at Fed liquidity provision through this cycle, it doesn't create more than a 10 or 15% possible pullback for me.
What do you see as the top risks or challenges for business in 2022?
Well, one area that I do like for people to look into is cybersecurity stocks. These are tech stocks, but they typically are very strong, profitable stocks. So these are areas in our system to look into and find your way into them in the next few months once the entire baby gets thrown out the bathwater kind of thing.
What about earnings as we open up the new year?
Like I said earlier, single-digit growth in earnings is what you should expect from next year.
All right, sectors that are going to be standouts. What do you think?
Hard to say that the infotech sector is not going to be your best bet. And after that, people like the financials because the rate hiking on the short end is going to create more cash for those banks. My own thinking is that certainly is a story people already understand and know well. I think the more interesting area would be in cyclical industrial names that can provide the kind of robotics and automation and productivity gains and CapEx build-outs for people who are suffering, labor shortages would be another area to look.
All right, meantime, let's look at a few stocks in some sectors you find attractive now, namely Hewlett-Packard Enterprise, Chevron, and the Blackstone Group.
Right, let's talk about the price behavior of these stocks, just so we know what's going on with this correction we're in. We're basically in a stealth correction. HPE, Hewlett-Packard Enterprise, this is a cloud stock. It's half of the old Hewlett-Packard, and its stock price has been sticking around $15 a share. And you get a PEG ratio of 1.3 and a forward PE of 7.4. Really nice stock from a dividend paying perspective. You get 3.2% of the dividend, the stock goes sideways. So, if you're an income investor, that's the name to know. Chevron, ticker CVX, this is the big oil company. It's about 116 a share now. It's done a really nice move here from the October lows at 95. It's probably priced very well now. I would not like this stock from that perspective. But again, the forward P is 14. And this, again, is the energies play that last year was excellent. I doubt it's the play this year. And Blackstone gets us into this idea that there's a play out there in the financials. PEG ratio 1.1, very good. Taking a big dive here from 150 to 120 on this pullback. If it indeed, you want to watch a stock like this and let this pullback happen, get even deeper and don't get in until the trend gets better. But this is a name you might want to pick up. Again, 3.5% dividend on this stock at this point in time. Among the three, this would be the most interesting to watch. I wouldn't buy it, but I'd certainly watch it closely.
A look ahead with our chief equity strategist and economist, John Blank. In a separate podcast, we're going to be looking ahead to the economy in 2022. Meantime, with John, I'm Terry Ruffalo. And right now, you might want to take a look at details on getting a free book, Finding Number One Stocks, as a matter of fact. A 300-page hardcover where Zacks Executive Vice President Kevin Matris reveals almost every stock-picking secret he's learned from the system that since 1988 has more than doubled the average yearly gain of the S&P 500. Go to more information at zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.